Bloomberg Audio Studios. Podcasts, radio, news.
Joining us now, Mike Wilson. He's Chief U.S. Equity Strategist at Morgan Stanley, and exceptionally well-timed here with a really smart Sunday note a bit ago on alpha over beta. Explain the Greek letters, Mike Wilson, to us. What is alpha, what is beta, and why does alpha win?
Hey, good morning, Tom. I think most of your listeners understand this. Beta is sort of your market level risk where you just own the index, and then alpha would be your stock picking. It's that simple. And, what's happened in the last 3 months is that the index itself has gone sideways, but there's been great opportunity under the surface. And that's really the job of most investors, is to pick stocks and try to beat the index. So it's a good outcome if it can sustain for active managers. And by the way, people say, stock picking market. It doesn't mean it's easy, but I mean, it does feel like that's what we're dealing with.
It kills me. He puts at the end of his note, Paul, enjoy your Sunday. Come on, Mike, it's Sunday. Exactly. Mike, I'm looking at the Bloomberg Launchpad, and I got a 199 on the 10-year real yield. My idiot ambiguity meter is that's a slowing economy. When you look at Seth Carpenter and company's work, do you model in a slowing or level economy where we walk away from double-digit earnings growth?
Yeah, well, I mean, remember, the economy is not always the market or earnings. And what we've seen in the last, I would say, really 3 years is an economy that looks fairly robust at the aggregate level. You can talk about that at the consumer level or just in terms of GDP. But then when you look at earnings growth for the last several years, it's been pretty lousy for most companies until recently. Recently, we've seen a pickup. More companies are starting to grow again. And I attribute this to essentially the government being, crowding out, if you will, much of the economy. That is the reason we have inflation. For the main reason we have inflation, too much government spending. Also, it has kept interest rates higher than they would be normally. So real interest rates at 2% is actually quite high, Tom, as you know, for the last 15 years. And we're such a financialized economy that, that has had a sort of a braking effect on, businesses that don't have easy access to capital. So I think the Fed right now is sort of in a tighter place than they probably want to be. They would like to cut rates, but they can't because inflation now is picking its head up again. So they're on hold. They're not going to raise rates in our view, but we're trying to find that equilibrium now. Like, how big should the government be? How can we liberate the private economy in a way where we have better velocity, kind of in the real private economy than just government?
Mike, I'm looking also at your chart book where you guys track what companies are actually saying on their conference calls. What's top of mind for corporate America? And I guess not surprisingly, one of those key issues is tariffs. How did tariffs kind of factor into kind of your view of inflation and maybe how the Fed will proceed and how that might impact stocks?
Yeah, well, I think the Fed has told you, pretty straightforward since December that the uncertainty around tariffs is another reason why they're probably going to take a pause on the rate cutting campaign. Now, remember, they have another lever they can use, which I think they will, which is to basically end QT finally, which is, a decent amount of repurchases then across the curve. They can probably start doing that in May or June. And that's another lever that they can sort of pull on. As far as companies go, I mean, companies are always, trying to incorporate these changes into their business models and how they're running their own companies. And tariffs are front and center right now because not only is that a potential headwind, but it's also uncertainty because, one day we have them on, the next day they're being delayed. And look, that's what companies have to manage that process. The good news is, I think in the last round of tariffs back in 2018, a lot of companies did relocate some manufacturing, some final assembly to areas like Mexico. I think that may be one of the reasons why the president is going after Mexico, because that was kind of a backdoor way of avoiding tariffs on China. So it's just going to be, 6 months of uncertainty. And that's why companies are mentioning it, because, they don't want to get caught, in a way where they're guiding too high and then tariffs end up being a headwind for their growth expectations.
On equity markets, we have Mike Wilson with us with Morgan Stanley, Bob Dole to join later. We welcome all of you on your commute across the nation on all of our different radio platforms. And on Bloomberg Podcasts, subscribe to YouTube. working for us each and every day. Subscribe to Bloomberg Podcasts on YouTube. Paul?
Mike, we're gonna hear from NVIDIA Wednesday after the close. That's one of the last big companies reporting earnings in this cycle here. What did you take away from this quarterly's earnings cycle, and more importantly, maybe the guidance you've been paying attention to?
Well, first of all, it shows that the fourth quarter was boom times. Now, some of that, once again, was government. Fiscal deficit was up 40% year over year. But also there was some excitement around, just a clean election, maybe a more pro-growth, administration. And so there was more activity in the fourth quarter. And so what we're seeing now is kind of just that rolling off a bit, that maybe we got a little ahead of ourselves. Higher rates and stronger dollar was weighing on some of the guidance for 25. Companies tend to do that seasonally anyways. They want to lower the bar a bit at the beginning of the year. But then the other things that have been we've been focused on, really in no particular order: tariffs, as you already mentioned. Number two, we have immigration enforcement, which has been a huge fiscal boost, and also a labor supply boost. And then we have DOGE, right? The Department of Government Efficiency. Right. They're off to an aggressive start. I'm optimistic that. I'm probably more optimistic than most that they can make some headway there. But remember, the more successful they are in the short term, the more growth negative that is in the near term before you get to the good stuff. And then, of course, the positive effects of policy like deregulation, maybe extending the tax cuts, those come later in the year. Those require congressional approval. And so that's just not, that's going to take 6 to 12 months. And so the bad stuff first, the good stuff comes later.
Mike Wilson, to get back to your idea that alpha is the way this works, and let's just generalize that as individual stock selection, what is the Mike Wilson process there? Is it securities research, Graham, Dodd, and Cottle, bottom up? Is it a sell-side concept of looking at what's going to win? Or is it more factor-based where you're looking at different items and trying to figure out, like say, will momentum or something else win?
That's a great question, Tom, and it has changed over time. I think the main thing that's changed in the institutional world, anyways, is the time horizon. So, 20 years ago, I would say institutional investors were kind of in this 6 to 12 month time horizon. It's now, 1 to 3 months, and in some cases, 1 to 3 days. So that's what's changed, and that means you just got to be really laser focused on kind of news at the margin, whether it's fundamental news around a specific company, whether it's a macro changing event that can affect certain companies differently. So all those things we look at, I would say that quantitative analysis and factor analysis has probably picked up the most. Most institutional investors now, including ourselves as advising them, use that tool, and it's quite helpful. As you mentioned, price momentum is probably the most important factor variable because everybody likes to perform. And I would say, that can also get you in trouble because what ends up happening is you end up, as I like to say, using price as your analyst as opposed to doing the analysis and then letting price follow. And I think that's just the world we live in now. Everybody's short-termism. I don't think that's going to change anytime soon.
Bottle that. For all of you worldwide, whatever your sophistication, what Mike Wilson just said there, and Paul Sweeney and I lived this, of where 3 years became 18 months and 12 months became 3 months, and what are we doing to window dress at the end of the quarter? The short-termism now, and how can you prosper by pushing against that, as Mike Wilson alluded to there. That was extraordinary.
Yeah, a lot of it, I think, coincident with the growth of hedge funds as well. Mike, what screens well for you guys these days?
Well, getting back to the stock picking, I mean, now this particular factor always screens well, but it's extremely important now is earnings revision breadth. So companies that are showing the ability to kind of continue to raise numbers, is you're getting paid for that more now than you normally do. You always get paid for that, but now you're getting paid for it more, and you're getting punished for it on the other side. The other factor that's really working is quality. Quality has been working really well the last 2 or 3 years because of that sort of crowding out feature. But in the fall, we saw a movement towards low quality, and then now we're giving that back. So large cap, quality, earnings revision breadth, those are the 3 most important factors. And of course, price momentum still is important as well.
How about on the industry side? What stands out to you guys these days?
So it's been consistent really since November. Financials, mainly the banks, as opposed to other financials and capital markets companies. Software, particularly relative to, say, semiconductors and hardware, they're less affected by tariffs. And there's some reinvestment now as we go from the enabler to the adoption layer for AI. That should benefit media and entertainment, not just
Really?
media and entertainment.
Wow.
And the traditional media entertainment names are doing well. Remember, those are mostly
Swinburne.
domestic businesses. Yeah, mostly domestic. Yeah. And then, of course, services, consumer services, which is the one part of the private economy which is still doing quite well. Services is doing much better than goods.
Mike, I'm guessing from your clients you get a valuation question or two every day. Boy, this market seems expensive. How do you respond generally?
We don't get many questions on valuation anymore. I think people have given up on that metric. That metric has faded in its importance in the short term. Okay, and as I like to say, in the short term, valuation doesn't matter at all. In the long term, it's the only thing that matters. So we've seen, as rates went back through 4.5% on the upside, we identified that as an area where valuation would matter. It has mattered, but not to the degree that it has historically. So I'm not sure what's going to get us, for that to become in vogue again. But it's not an important factor at the moment.
Talk to us about breadth of the market, Mike. A lot of folks, and Torsten Slok today was just out with a note from Apollo just talking about the concentration within this equity market, particularly in big cap U.S. technology names, and how that's really relative to the rest of the world just getting more and more pronounced. How do you think about breadth or lack of breadth in this market?
Well, it gets back to quality. So, and I would say as bad as the concentration is in the U.S., we have like 5 stocks or 30%. It's even worse in places like Germany, where you have 3 stocks or 35%, or in parts of Asia. And what's going on is the same thing that's going on here, which is that people are crowding into kind of these large cap quality stocks. It just so happens that the U.S. has more of them. So, but in other places of the world, there's fewer of them, why the crowding is even more so. So it's just more of the same. Basically, people, the markets are smart. They've crowded into what's working. What's working is large cap quality, particularly quality growth, and that because they have scale and they can operate in this world where perhaps rates are high. The government is a big part of the economy. You have a lot of uncertainty, multipolar world. Geopolitics is, kind of putting pressure on certain regions. And, I think that continues for the foreseeable future. The thing that could change that, which I'm getting a little excited about, is if we can shrink the government. So imagine this. You have a recession in government. I'm not sure that would be that bad for the private economy. I'm not sure we're going to get that. But if we did, that would potentially change that dynamic.
Right. Mike Wilson, very quickly here, talk about enthusiasm. I mean, Michigan State taking out Michigan in basketball, that was like Big Ten classic, wasn't it?
Well, it was a classic for if you're not a Michigan fan. But
they can still come back.
The Big Ten is always competitive, Tom, as I like to say, in both basketball and football and other sports as well. So, and Big Blue has had a good run recently. So we're going to leave.
Yeah. I mean, they're in second place. And they have the 2 teams up top. A Big Ten is important. Why is USC in the Big Ten? Does Mike Wilson understand? Please help me.
So the kids
here.
from Los Angeles, they come all the way to Piscataway, New Jersey to play basketball.
Oregon is in the Big Ten. Mike Wilson, this is un-American. I hope Michigan takes every victory from the way on, pushes those Westerners out of it. Mr. Wilson is with Morgan Stanley. Thank you so much, Mike Wilson.